Currently, the life expectancy in India is 70 years, and with the advancement in the healthcare industry and better lifestyle choices being made by people, this number is expected to reach 80 plus years by the year 2050. Since people lose their active income post 60 years of age, it is imperative that you plan for your retirement in advance. Hi everyone, my name is Harsh Srivastav, and in today's video, I will shed light on how NPS can be a great choice to invest your money, save taxes, and at the same time build a financially secure retirement life. So let's get straight into the video. NPS or National Pension System is an initiative by the Government of India to provide retirement income in the form of pension to all citizens of India. When it was initially launched in January of 2004, only the government employees could utilize the benefits of this scheme. It was only after May 2009 that the scheme became open to all citizens of India on a voluntary basis. For the government employees, except the state government employees of West Bengal, NPS is mandatorily applicable. Now, since wherever money flows, the existence of a regulatory body is a must. In the case of National Pension Scheme, it is the PFRDA, Pension Fund Regulatory and Development Authority. It operates under the jurisdiction of Ministry of Finance of the Government of India. Individuals who register an NPS to accumulate a corpus for their retirement become the subscribers of the National Pension Scheme. Each subscriber is given a unique number called PRAN, which is a 12-digit permanent retirement account number. This number is portable and so it stays with the subscriber throughout his life. The money that is contributed by the subscriber is invested in pension funds, and on maturity, the subscriber gets to use the accumulated wealth in the form of a lump sum payment and an annuity. Annuity is nothing but the monthly pension that the subscriber receives. Also, the annuity portion in NPS on maturity has to be a minimum of 40% of the total accumulated corpus, and it can go up to 100% of the accumulated corpus. Currently, the PFRDA has empaneled 14 annuity service providers under NPS who are responsible to provide annuity payments at the time of exit from the scheme. Coming to the eligibility criteria, NPS works on an all-citizen model, which means that applicants can be both citizen of India or an overseas citizen of India. The age bracket to register an NPS is between 18 to 65 years, and the applicant must comply with all the KYC norms that are mentioned in the registration form. Let's now dive a little deeper into the different types of NPS accounts. Basically, there are two sub-accounts under NPS, the Tier 1 account and the Tier 2 account. The Tier 1 account is compulsory to hold if a subscriber wants to partake in the NPS scheme. The Tier 2 account, on the other hand, is voluntary in nature, meaning that a subscriber has option whether to invest in it or not. To open a Tier 1 account, the subscriber needs to make a contribution of minimum 500 rupees initially. In the case of Tier 2 account, the subscriber needs to make a contribution of 1000 rupees initially. Now that the account is open, a Tier 1 account holder needs to make at least one contribution each financial year, and the minimum contribution that he has to make every financial year is 1000 rupees. Also, the minimum contribution that a subscriber can make at once is 500 rupees. So if you even want to do the bare minimum, you will have to make two contributions of 500 each in one financial year. One should note that even corporates can contribute towards an employee's NPS. However, the investment that is made by the corporate cannot exceed 10% of the employee's basic salary and dearness allowance. In the case of the Tier 2 account, there is no such minimum contribution that is required to be made in one financial year. Also, the minimum contribution that a subscriber can make at once is just Rs 250 as against the 500 rupees in case of Tier 1 account. One great benefit though of investing in Tier 1 account is the additional tax exemption of 50,000 rupees that the subscriber receives under the section 80CCD 1B of the Income Tax Act. This exemption is over and above the 1.5 lakh limit under section 80C. On the other hand, the Tier 2 account does not hold any tax exemption benefits. Also, one should know that money can be transferred from Tier 2 account to Tier 1 account but the vice versa is not allowed. A subscriber can open and operate his account by going to the point of presence or POP. POPs are basically service providers who help in verification and processing of forms, making contributions towards NPS, changing the details of the subscriber in case needed, and handling any other grievance that the subscriber might have. For your ease, I've left a link in the description box so that you can go and see the list of registered POPs in India. Now let's look at how much returns you can get by investing in NPS. Well, on average, NPS gives a return of 9 to 10% annually. It is a preferred investment choice of many individuals because the returns are generated with less risk and exceeds the returns of provident fund or the regular fixed deposits. If we delve deeper into the asset allocation of NPS, we get to know that there are two options that a subscriber has for his investment in different asset classes. The first option is active choice and the second option is auto choice. As far as active choice is concerned, here the subscriber is given the freedom to design his own portfolio. The portfolio can comprise of 4 asset classes. The first one being equity. The subscriber can choose to invest up to 75% of the corpus in equity. The second asset class is alternate assets. Here, the subscriber can invest a maximum of 5% towards instruments such as infrastructure funds or real estate. There is a cap of 5% because alternate assets carry very high risk. The third asset class is corporate bonds. Corporate bonds carry a moderate risk and they give a modest return of 7 to 8% annually. Last but not the least, the fourth asset class is government securities, which carry the lowest risk of all. Coming to the auto choice of investment, here the contribution made by the subscriber is invested in a predefined proportion depending on the age of the subscriber. In the auto choice, the subscriber is given the option to choose among 3 life cycle funds. The first one is aggressive life cycle fund, wherein 75% of the contribution goes towards equity till the subscriber reaches 35 years of age, and thereafter a certain proportion of the equity exposure is transferred to corporate bonds and government securities every passing year. The second one is moderate life cycle fund, wherein the equity exposure is 50% till the subscriber reaches 35 years of age. And lastly, the third one is conservative life cycle fund, wherein the equity exposure is just 25% till the subscriber reaches 35 years of age, and thereafter it keeps on reducing year after year. For more clarity, you can pause the video and look at this table to understand how the proportion mix of equity, corporate bonds and government securities keep on changing in all the 3 life cycle funds. Now you know how your money is invested under NPS, but who does all this work for you? Well, as you can see on your screen, there are 10 pension funds that are registered under NPS. Out of these 10 pension funds, the government employees have the option to make their contribution towards SBI, UTI or LIC pension funds. For others, they can choose to contribute using any of the 10 registered pension funds. Now, before investing in NPS, the subscriber should also be aware of the early withdrawal and premature exit rules that are applicable on Tier 1 account of the NPS. I say only Tier 1 account because there is no lock-in period in Tier 2 account and a subscriber can choose to invest or withdraw money at any point of time. In the case of Tier 1 account, a subscriber can make a partial withdrawal of 25% of the total corpus if he has been investing for 3+ years. However, the PFRDA has stated that this withdrawal amount can be used only for specific purposes such as your children's education, marriage, medical treatment of self or family, building or buying a house, etc. In the case of complete exit from the NPS scheme, the subscriber should have been contributing for at least 10 years if he is a salaried individual or at least 5 years if he is self-employed. Now, if the total corpus is below 2.5 lakhs, then the subscriber can choose to withdraw the entire amount in lump sum payment. However, if it exceeds 2.5 lakhs, then at the time of premature exit, 80% of the total corpus would go towards buying an annuity and the remaining 20% would be paid out in lump sum payment. The last thing that you must be aware about in case of tier 1 account is that it falls under the exempt, partially exempt category, meaning that the contributions you make towards NPS are exempt, the returns that are generated on the contributions are also exempt, and finally, at the time of maturity, the 60% lump sum payment that you receive is also exempt from tax. With regards to the 40% of the corpus that goes towards annuity payments, the subscriber will have to pay tax on it as per the income tax slab they fall in. So in a nutshell, NPS comes with a lot of benefits and it should definitely be seen as a viable option for investment. Thank you so much for watching. Like the video, hit that subscribe button and stay tuned for my next video.